In this video, I'm going to talk about the 1 hour trading setup on US dollar JPY. Stay tuned. Hey traders, a very warm welcome to you. Okay, so US dollar JPY, this is a strategy that we use to look for a breakout. Now the advantage of this strategy is we're only looking at one currency pair, we're only looking at one time frame, and we're only looking at one specific hour in the day. So if you want to start automating something, not a bad place to start. Is this profitable or not? It's got potential. Does it work every time, all the time? No, it doesn't. But if you can filter out some of the worst conditions, filter out some of the better conditions, it's got some mileage in it. Let's look at the rules first of all. So we are looking at the first hour of the Asian session. Now, midnight Asian session starts. It's going to depend when you're on British Summer Time or GMT or wherever you are watching this video in the world. So check it out for your current time and make sure you're using the right candlestick and the right time for that. So what we do is we do this. We say, okay, let the Asian session start, and we know that the currencies flow in 24 hours a day, but money flows in during London, money flows in during US, money flows in during Asia, London, or Europe, Asia, whatever, however you want it to put it, but the money flows round with the sun. So what we're looking for is we're looking for the first hour of the Asian session, and this is why we're using the US dollar JPY. We're expecting money to flow in or out of the yen. And what we're going to do is we are going to bracket the high or low of that initial hour. So we're going to put a stop entry a couple of pips above the high, and a stop entry stop entry long a couple of pips above the high, stop entry short a couple of pips below the low. So the idea being is once we've had the first hour of trade, we've had the high or low, we are going to enter on a subsequent break of that high or of that low, and our stop is going to be the distance of that candle. So the high minus low in pips, that is going to be our stop loss. So let's look at an example here now, guys. So we have the first candle at midnight, and I have my bracket. So I put my high, I put my low in, I put my high in, and I have a little look at the chart here, and it says 112.7, it says 112.55. So it's a relatively tight stop, that it's okay, but I'm going to have my entry a couple of pips above that. So I'm going to be, my long entry is going to be 112.72, something like that. Again, up to you how flexible you want to do it. I would say let's just see how much range you've got as well on that first hour, and just tweak it to adjust it. But to be honest, a couple of pips here and there is not going to make a lot of difference to your bottom line in terms of entry and exit. But what you don't want is kind of to be just caught in by just touching the high. You want it to break through. So a couple of pips is not a bad way to start, but don't over focus on stuff like that. Okay, so in this example, you're long, we're in at say 112.72, and this example, it's a nice move. You know, at 2 o'clock in the morning, we had a good what have we got there? A good kind of high minus low, a good 50 pip move, and more actually by the look of it, but a nice hefty decent move which we would end up taking profits on. I'm sure that we would end up scaling out probably some or how I would do it, and again, comments below on how you would do it. Always interested to hear how other traders do this kind of stuff. So my risk, let's say my risk on this is whatever it is, just approximating it, 20 pips or so, 15 pips, let's call it 20. I would look to take some off at plus 20 pips, and that's really what you're looking for minimum, guys. You're either looking to scalp it at plus 20 or say, okay, you know what, I'll take some off at 20, some off at 40, some off at 60, some off at 80. I'll always leave some to trail with a kind of trailer that runs up behind it. So leave some for a home run, but always looking to sort of manage that risk and take some off the table. So that's the theory of the trade. Now, it's not going to work every time, all the time. Now, if we look at this example here, you can see one here. Let's go and look at this one as it's on the screen. You know, this one is okay. It gives you a little bit of juice. Now, what's the low on that? The low is 99, so call it 113. And the low on this is 88. Not enough there to take your 20 pips before you kind of took out the high, but you get the idea. The point is, hopefully, the stop loss is relatively small. And the idea being is that you want to get onto that on the end of a really big volatility expansion. So if a lot of money starts flowing in or flowing out of the yen, you're on board it. You've got a nice narrow stop. You can ride that train for the rest of the Asian session, taking profits as you go. the downside of that is you're going to get stopped out a few times. But if you get on the end of one of those, that's why the market conditions are so important for these type of trades. If we are in a real wide range environment, if we are really kicking off and there's news and stuff coming out, obviously be careful of gap risk, but just all those kind of attributes that are good for volatility expansion type trades. This is the type of trade that you want to be involved in. Anyway, guys, thumbs up if you liked it, and comments below any thoughts, ideas, anything to do with this trade or other similar strategies. And if you want to see more of this strategy teardown, trade teardowns, all that kind of stuff, subscribe for me and other traders on this channel. Take care, good trading. See you in the next one. Bye bye.